Welcome to Module 6 of the Small Business 101 webinar series. This module is all about your financing in your business. Now that you have your business plan, you know what capital you need to start up your business and make it a success. This module walks through all of the different avenues to get the funding as well as a decision tree to decide what funding is the best fit. With this module, you will know the steps to take to get the funding you need. This is the sixth module of 10 that complete the Small Business 101 webinar series. The Small Business 101 series will get you started with some of the most important information you need to know as a startup entrepreneur. What financial methods are available to you? The goal of this module is to have control over your business finances and have a plan to get the money you need to start your business. In the last module, we walked through the business plan that included your financial projections that you will need no matter what financing path you take. Now that we have our financial projections and know how much funding we need, let's go through the different ways that you can finance your business. A lot of business owners think that the best way to finance their business is a bank. And although this is a common way, it is definitely not the only way. A common mistake that an entrepreneur makes at this stage is focusing only on how much funding they can raise. An equally important part of financing is how much you can save. And this is not just about your business, but personally. Are there things that you can cut back on? Do you need to have a car lease? Or could you just get by with transit or an older car? Do you have to have that second coffee every morning? This may sound a bit trite, but you need to be realistic in determining what money you will need, the must-haves. Let's get started in understanding your financing options. To do this, we're going to talk about the following financing options. Financing this yourself or with your partners if you have them. This is and would be your personal assets that you already have on hand. Financing through your friends and family's assets. Loans, which is often through banks or credit unions. Grants, which have historically been available for not-profits but are increasingly being available to social enterprises as well. Angel investors and venture capitalists. And crowdfunding, which is one of the newest forms of financing. Let's begin. As we walk through reviewing each of these financing options, use the resource guide on how to present to investors and funders to find additional information and resources. Personal assets. A lot of entrepreneurs would rather spend someone else's money than their own. But when you start your own business, no matter what type of financing that you put in place, others are going to require that you put your own cash into the business. This is especially true with banks. A lot of entrepreneurs don't like this, but this is the reality. Think about it for a minute. Why would they invest or loan you money if you aren't willing to do the same? Putting a little skin in the game is important, and pretty well all of your financing options will require this. So when should you consider personal assets as a financing tool? Every time. With that in mind, what should you be thinking about in terms of your personal assets? You should have at least 6 months of living expenses saved up inside your bank account. No matter what type of financing that you end up going with, it is not going to be paying for your living expenses for the next few months. This is a very important point, and many budding entrepreneurs fail to consider. You want to make sure that you have enough money to cover a reasonable period of time and your living expenses. The only time that you don't have to be worried about this is if there is other income supporting you and your family. This could be your spouse, if your spouse is working, or if you have investments that are giving you some income. Part of this process is making sure that you have minimalized your monthly payments. Car, phone, hydro, mortgage, how can you cut back? And then consider if there's any other way to cut back so that your absolute need of living expenses is minimalized. This will put less stress on you as you start up your business. Let's now look into friends and family as a source of financing. Or should we say family, friends, and fools? It is great that these people are so supportive in the work that you are doing that they wish to contribute financially. Of course, there are challenges in this. Are and do they really understand your business? If things go badly, will there be resentment and your relationship, will it be lost? To mitigate this, you need to make sure that they are fully informed in what you are doing, and it needs to be clear that it might not work out, as 50% of businesses don't make it to year 5, and of those, only a few make a significant profit. So when should you be considering friends and family as a financing tool? When they have money they can afford to lose, and they understand that this could be a real possibility up front. Loans are the most traditional form of financing. The federal government has created a small business program to reduce their risk in funding a small business owner by securing it. But remember that a lender is always concerned about risk. So the banks and credit unions have a process to help them protect against the risk of you not paying them back. Here is what they need in order to finance you: a business plan. As covered in Module 5, each bank or credit union will have their own business plan template that they would want you to complete. They will typically wish to have a couple years worth of financial projections. If you are already in business and seeking a loan to grow, they will also complete an analysis on your financial ratios to ensure that you are within the acceptable criteria. Next is credit history. This is important in that it needs to be at a specific threshold to get a loan at all. After that threshold, the credit history will support you in getting a competitive interest rate on your loan. The credit history will be yours, that they look at, and your partners if you're setting up a partnership, or other owners if you are incorporating. Finally, there is collateral and security of the loan. This will have to be either cash, investments, or assets that are worth the same value of the loan that you can secure it against. Often, even with a corporation, a bank or credit union will require that you as owner of the business have a personal guarantee on the loan. But once you are up and running, some lenders will use a purchase order, also known as a PO, or your accounts receivable as security against a loan. So this can be creative. So when do you want to use a loan? A loan is best used to grow an existing business, as you can leverage the business assets to help with the future. Leveraging money to grow actually means that you get a larger return on investment based on your own invested money in the business, those personal assets that we discussed earlier. But in the beginning stage, this is often difficult without your own personal guarantee. Grants. Grants historically have been designed for nonprofit organizations, but as a better understanding of social enterprises is emerging, there is more willingness for foundations and large organizations to grant for profit organizations as well. You could be eligible for this if you can demonstrate that you're making a social or ecological impact in the world. In addition, governments will grant small business startups. There is the Summer Company Grant Program, as well as the Starter Company Program that grants startups as well. The key to getting a grant is to make sure you talk to the grantor first. They wish to grant you, as the grant has been set up to make a difference. The more and better applicants they get, the better they are doing. By speaking with them, then, you can get a better understanding of their strategic goals, their eligibility criteria, your chance of success, and what of the grant application to focus on, and what is the most important part to them. Also, by speaking with them, you start a relationship, which is always a good thing. Next, you simply want to follow the guidelines. Eligibility criteria is half the battle, so make sure that you are being detailed oriented and answering what is being asked. The next thing is to make sure that areas that are being evaluated more intensely, that you spend some extra time there and make sure that you haven't left any gaps in your explanation. And finally, where possible, focus on systemic change. The grants, especially by foundations, are designed to create a long-term impact in the community or society. Focusing on how the work you are doing is going to contribute to that big picture or strategy will put you above the other applications. So, when to apply for a grant? Only after you have a conversation with someone and verify that your business is a good fit. You will also be referring to your business plan in many cases when you are talking to the grantor. Angels, venture capitalists. Now let's talk about these two. Angel investors are investors that wish to do seed funding to get new ideas off the ground. They typically fund up to $500,000. Venture capitalists are investors that take the fledgling business and take it to the next level of growth. Typically, they fund between $500,000 and $2 million. Both are closely involved in the growing business as they bring in their contacts and business expertise. So, an important part of securing financing from these sources will be to know how involved they will be in your business. You will need to be comfortable with this involvement, so make sure you understand what it is upfront. Generally speaking, especially with venture capitalists, there is a more robust vetting and due diligence process, which is done before the financing is released. There also is more rigid reporting requirements. To get an angel investor or venture capitalist interest, it usually isn't a traditional business plan. It's a presentation, and usually it isn't more than 20 slides. Here is the sample format. Slide 1, vision. What is the big picture and where is this heading? You want to be inspirational. Slide 2, validation. What is the existing proof points that you have to prove that this business idea will work? Slide 3, market overview. What is the lay of the land? Only include the most important market research here. Slide 4, the problem or opportunity. What is the gap that you have identified in the market that you're going to address? Slide 5, the offering. Go into depth into the specific business idea that you have. Slide 6, revenue model. How are you going to make money? There shouldn't be more than 2 or 3 ways, and best to focus on the primary revenue stream. Slide 7, marketing and growth strategy. How are you getting the word out there, and what does the future look like? Slide 8, the team. Why are you the right person or the right people to do this? Slide 9, financials. What is the upside in this opportunity? Slide 10, the competition. How are you different? What risk do they present to you? And slide 11, the ask. What do you need from the investors, and what will that look like? Crowdfunding is the newest financing tool. This is not ideal for everyone, but this is great for catchy, fun new products like board games, toys, funny clothing, etc. Compelling stories that are making an impact, like for charities or fundraisers, and something that can connect with someone instantly, like art. Depending on what your business idea is, different platforms will be a better fit. Kickstarter is great for the for-profit that is launching something new. This is the quirky product area, and often artists will use this as well. Although this is a competitive platform, it also gets a lot of traffic. GoFundMe is great for funding a personal story and something that has impacted you or someone else and has inspired you with your business idea. Canada Helps is great for existing charities, as you already have an account set up with them automatically, and you can use their crowdfunding tools to ramp up your campaign. With the rules on crowdfunding still evolving, there is tremendous growth in this as a financing tool. Plus, there are new platforms popping up each month, so do your research. Once you choose your platform or platforms, you need to figure out how to stand out. Videos and personal stories are key. Visuals and getting your friends and family to help some traction early on will all help as well with your visibility. Although this can pay off, the results are not guaranteed and is often a lot of work. Now that we have walked through the financing options, how do you decide what is the best for you? Use the finance decision-making tree to help you. Remember, each financing option has its pros and cons, so you want to think carefully about what you want to pursue. Your financing needs may change as well as you start your business, so don't think the one you start with is the one you have to stay with. Many times, entrepreneurs start with their own personal assets and then go to a bank or other financing option once their business is running and they can show consistent growth and profitability. Module 6 was all about small business financing and the options that you have. We went through each financing option to understand the details about it. Now, as you start your business, you know the options you have for financing and the importance of keeping your finances under control. Module 6 is the 6th of 10 modules for the Small Business 101 webinar series. Let's get going.